Hello traders, Nick Sheen here looking at the SPY. So today is Monday the 27th and everybody's having a freak out in the market over the so-called virus. First of all, the media is in the business of making everything extremely interesting, whether it is or it isn't. It's sad for the people that are sick as far as virus is concerned, but it's by no way, shape, or form yet, with the news we have, it is anywhere to be compared with the deadly viruses. I think the death rate on this one is like 2% or something. I'm not an expert, but these are the easy math I'm doing, how many cases there are, how many deaths there are. And so, first of all, they don't even tell us the name. I believe the coronavirus refers to the whole group. So what's the actual technical name for this one? I don't know. So I'll continue referring to it as a coronavirus because that's what they do. But the point of today is to how does this impact the trading? First of all, if I'm invested for the long term, this is nothing for me. If I'm long Facebook for whatever reasons, I was long Facebook, for example, this is not a recommendation to buy anything. I'm just making an example. This virus thing is nothing to affect the Facebook P&L going for the long term. That's why you buy stocks, because you believe in the P&L or in the balance sheet or a combination of both. So this virus reaction here has nothing to do with the virus reaction. The stock market needed to go back and check levels from which they broke out. They broke out and they rallied. It doesn't rally forever. They have to correct. Turn off the news. This was going to happen. Last couple of weeks, I said this was going to happen, and I said here's how I would trade it. I would start building a bearish position. All these positions are a double today. So this is where instead of people rushing to buy puts, they'd be selling their puts for profits for people who are panicking into buying the puts. Also those who sold call spreads, this is the day you book them, or you sell put spreads against them to make them into iron condors, for example. If you don't know what that means, it just means that you made the opposite bet before it happened because it was about to happen. I didn't short markets for being short. I shorted levels that I thought were extended because I had a plan in action. So this is the S&P 15-minute candle. So it looks pretty scary, but it's like 1%. We haven't had a down 1% since October. Friday we almost did, but then we didn't. So I'm going to start expanding timelines. So I'm going to double that. 60. So now already I know why the S&P stopped here. If you look left at $323 roughly, that was the last consolidation zone, the last base from which they sprung for this rally. They gave it back up. That's fine. That's totally normal because they came back to test the footing from which they broke out. If it holds, they can rebuild and break to new highs. If it doesn't, then this becomes the trigger to short. So this is at one timeline, one time frame. The story changes depending on how fast I'm trading. So this is a slightly slower trader. Same message. It fell to the point of control, which is where they were busiest, that orange line. That's what that marks. It's where most of the trading happened. That's what the orange line is. It's mathematically calculated. I didn't make it up. I didn't draw it. It just automatically shows up. So I do have an orange line here dashed. That's mine at 317 and change. That's my eyeball for the next place where they might find footing. There are a few levels in between, but this is the big one. And if that's lost, they will fill the gap down to 317, 316. So again, this is just one time frame. I'm going to double that. I'm going to go to 2-hour candles. So now the mathematical number moves because all these are new profits. So this is where most of the action has happened with a node here. And so I picked the right level blindly, not blindly, but it matches mathematical confirmation, I should say. So there is a cluster right here that's interesting. So if I pick 3 lines other than today's low, losing today's low, we make a beeline for 320-ish. We could go down to 316.17. These are support levels, both of these. Worst case scenario, we get down to 312, and this is also support level. I say worst case scenario on this time frame. Okay, this is 2-hour charts. 4-hour charts. Now you see worse levels that are even further down, under 300. Oh my gosh, under 300. Yeah, well, so what? It all depends on where you're based from. So 300 is a round number. but there's a number around 304 or 5 that sticks out. There's a number here that sticks out. So let me see here if I unhide my numbers, my lines, if they're going to match what I just said ad lib here. So these are lines I drew weeks and weeks ago. So I knew that here something was going to happen. I didn't know which direction. So I say, okay, if it breaks lower, this is where it's going to go. If it breaks higher, this is where it's going to go. Sure did. Matched the number I thought it was going to go there. So you take it one level at a time. So I'm going to zoom back in to get more important information to today's trade. So this is we'll go back to 120. Okay, so I'm starting to see interesting stuff. Let me see if I go to 60, do I lose it? Okay, so back on the 7th-ish, I drew a line and a box. And look at today's low. So this was 20 days ago. I drew a line on a box. Today's low. I'm not Nostradamus. I didn't know this was going to happen, but I knew this was the level that was going to come into play. Same as I thought that this level will come into play, and it did. So the history on the chart is a guide to levels. It's not that I'm going to see it come back to it. It's what I do once it come back to it. So on the day where I see this, I don't start buying puts because that's where they're going to find support because it was a battle zone back then. So when it comes back to it, whoever bought it here is going to say, hey, I made money last time I bought it here, I'm going to buy it. So they're bouncing. If they don't hold the bounce, then you get this inverse cup and handle thing. So I don't buy puts in panic because I know that they're falling into a level that's significant for me. But they're bouncing now. And if they do this and then lose it somehow, then it becomes some sort of an inverse cup and handle. And the downside, technically by the experts that do track this stuff, will tell you probably 314-ish. I tell you, okay, maybe eventually, but there are several levels in between. I already discussed them. The dashed line, this orange line, and this line I also picked. So the whole zone is significant, but it all depends on which level, which time frame you're trading. So if you're panicking, buying puts for a trade, that's the wrong place to buy it today. On the bounce, maybe you can reload puts, but the trigger to short again is below this level because technically it should go down to here, or at least it should go towards there. So this is the technical aspect of it. What about the fundamentals? They have not changed. Okay, my thesis has been from 2,800, 2,700, when people are going to 2,500, it's still the same. Can't fight the Fed. Fed's still friends. Can't fight the trend. Trend's still up. Can't fight, a boring tape, whatever. You can't short a boring market or something like that. And the market that are climbing a wall of worries. It's all happening. So eventually they will buy the dip. What level they buy it at depends on the time frame I'm trading. So if I'm a fast trader, I should have bought the dip this morning. Made money already if I did that. If I'm trading for the next couple of weeks, my next bet would be the earnings. We've got Apple, Microsoft, Amazon, Facebook. I'm forgetting people. Starbucks. All these guys are going to be reporting this week, and we have the Fed on Wednesday. So the Fed is not likely to change. So this virus thing, if anything, is going to make the Fed maybe add one of the list of their worries. So this is going to make them more bullish. So it is important to know what levels I'm fighting or trading that match the time frame I'm trading. So my thesis, if it's playing the earnings, then I should just bet on the earnings. Either pick one of the ones I like Facebook, for example, or pick an ETF of the ones I like Facebook and Apple and all of that. Then I'll do the Qs. But I have to make sure I'm taking the bet for the right period of time. I don't want to short any premium in this week because it's too violent. I don't know which way it's going to go. And if I make a mistake, it's hard to recover. It's tempting to do it during the week to expire it and make money every week. But I can make the same money betting long term. So I did that with the TLT, and I shorted a whole bunch of put spreads throughout the year out until May. They are all maximum wins today, almost. I can book them, or I can make them into iron condors. So same concept as before. Whatever bets I have that are winning, I should lock some because I can't overstay my welcome. We've seen too many V recoveries. Not that this one will be one, but it has the makeup to be one. So are there stocks running? I should trade each individual stock. based on its own chart. Square looked good on Friday. Today it reversed and now it's green, looking to fill the gap. So usually it disappoints people, but maybe it does fill the gap. So there are stories. Tesla would not be the one I would start buying the dips, because it has so much, I want to call it froth, don't get upset, new profits that can come out fast if the if the markets still continue lower. Apple. So what if this dip was a reason to buy the earnings? So what if market makers knew that Apple is going to blow it out of the water, but they can't react too big from 325? This is $10 dip this morning, gets you into, hey, maybe I can bet long on Apple now, right? They report earnings on Tuesday night. So Wednesday morning, the open on Apple is a complete coin flip, and then the Fed right after that. But here's Apple example, levels. Look at today's low. I drew this line last week, 2 weeks ago, I can't remember. Today's low, it's the first line that comes into play. So it's not a crazy scenario that it stopped right here. But just like the S&P, if they form a right handle, they could get to my second line and third line. These are fast profits. This is unusual for Apple. And Apple is expensive relative to itself, but not in absolute terms. It's still a great company, makes good money, and it's still cheaper than Facebook. But relative to itself, it's almost double as expensive as usually. It's selling at 6 times, well, it was 6 times its sales, and about 28 times on the PE, not times, the ratio, the PE. So in relative terms, it was expensive. Maybe this gives people the guts to say, you know what, I'm going to bet up on Apple. And then they won't be disappointed with the earnings, and then they'll say, man, this report even better than last time. I'm going long. So I'm not emphatic on any in any trade I have. I book it quickly. I was bearish going into these highs for good reason. I've been bullish the whole time. So this is the time where I said, hey, I won these short-term bear bets. Thank you. I will reload short if we lose these, but I should book some. That's my point. All right, Nick signing out.